Hi friends, welcome back to the channel. This past 1 week the market is a bit crazy. I know some of you have seen a huge drawdown in your portfolio. I can feel your pain because my portfolio also dropped quite a lot. So it is during period like this that I would like to remind everyone that over the short term, market could be extremely volatile. But if we invest in good companies, our portfolio will do well over the long term. The banner of this YouTube channel and also the name of our Telegram group is Invest for Long Term. What does it mean by invest for long term? How long is long term? What is the difference between long-term investor versus short-term investor or traders? In this video, we will discuss in details. What is long-term investments? Long-term investments are those that you know you are likely to keep for a long time. But how long is long? Is 2 years considered long? Or you really need to invest with a horizon of 20 years, then only considered long-term? To me, the long-term is not really about the investment horizon in terms of number of years. It is more of a mindset that we as an investor adopt. What do I mean by that? To help illustrate this, I will compare the mindset of a long-term investor versus a short-term trader. Before that, I would like to clarify that I'm not making a case that long-term investing is better than short-term trading. These are essentially two different activities, so there is no good and bad. You just need to choose the activities that suit your own style. First, you need to understand what are the forces that drive the stock prices over short-term versus long-term horizon. Over the short term, stock prices are driven by supply versus demand towards the stock. For example, Tesla share price went up by 730% in 2020. One of the main reasons is the increase of demand on the Tesla shares. There are many investors that have been avoiding the company prior to 2020 because the company was unprofitable. In 2020, Tesla has turned profitable and that leads to a bigger investor base. Prior to 2020, Tesla was shorted heavily by the short sellers.
You don't get to trade at a $50 billion enterprise value, which is where it is today, which is twice Ford's enterprise value, despite having no cash flow to speak of, whereas Ford trades for half the enterprise value and has 2.5 times EBITDA multiple. So what you do from here, Scott, my thought is that if you put the trade on the short side in the high 300s, because of the volatility of the stock, which is inherent, you hedge it out or take them off. But I think inevitably you have a stock that's headed into the single digits.
As the fundamental improve, the bear case has become invalid. Short sellers would need to buy back the shares to close their short position, hence increase the demand. Besides that, the S&P 500 inclusion forced hundreds of billions of dollars from the ETF into the company, which create huge demand on the shares. As demand increase, so do the price. Next, stock prices are driven by overall sentiment of the market over the short term. This could be the event or development that affect the mood of the market. The impact could be felt by the entire market. For example, the massive QE that was initiated in March 2020 pushed all the stock price to a high level. It could also be sentiment that affects certain group of stocks. For instance, the recent inflation hike that prompt investors to worry about rising interest rates, which then caused a correction on many growth stocks. Third, the sentiment towards the specific company. These are the company's specific news. For instance, a Tesla car accident might cause the share price to drop because the investors are getting nervous. The above factors drive the stock prices over the short term and the impact could be significant. However, they usually do not have a long-term impact to the stock prices. In Tesla case, do you think that the S&P 500 inclusion will cause the share price to increase by additional 10% for the next 10 years? Obviously not, because the change is only one-off. Tesla can't be included in S&P 500 once more if they are already in the S&P 500. And the Tesla car accident that happened in 2015 will not affect the share price movement over the long term because people's already moved on to chase the latest news. What drives the stock prices over the long term? I will borrow the quote from Peter Lynch. I think you have to learn that there is a company behind every stock and that there is only one real reason why stocks go up. Companies go from doing poorly to doing well, or small companies grow to large companies. So if the company can turn from small size to bigger size, referring to the increase in sales, or from not profitable to profitable, or from less profitable to more profitable, then the share price will go up for sure over the long term. The profitability is an underrated criteria, especially among the growth investors. Many will just brush away profitability by saying that of course these growth stocks are not profitable. They are investing so much money in the business expansion and R&D, hence profits will come later. Yes, I agree with that statement, but that doesn't mean we don't have to assess whether the company will be able to turn profitable. Take Nikola as an example. They don't even have a working product. How could they have a revenue that will ultimately make them profitable in the future? Are they going to have a product in the future? This one you really need to do your due diligence to find out. Contrast that to a company that have solid track record and products that people like, such as Apple. The amount of due diligence work could be lesser because you can reasonably expect that they will launch a new iPhone by end of the year and that will encourage their customer to upgrade to a new iPhones, hence increasing their sales. What about companies like Tesla? Well, Tesla have a product that customers like and they are ramping up the sales at an impressive rate. Does that mean that as long as they produce more car every year and maintain the profitability, the share price will definitely go up? Aside from the company fundamentals such as revenue and profitability, you also need to consider what has been priced in the share price. Last year, Elon has communicated that Tesla is aiming to produce 20 million cars per year by 2030. This year, they will produce around 800,000 cars. This implies an average growth rate of around 40 to 45%. So for a company like Tesla, if they only grow by 10 to 20%, that will not be sufficient to boost the share price. They need to deliver higher than what the investor expect. This is why even though the recent quarterly earnings, Tesla announced 74% increase in revenue, the share price still hasn't gone up much. Of course, there are other reasons. They reported earnings of 438 millions, but 101 millions of the earnings came from the sales of Bitcoin in the quarter. They also recorded 518 millions in revenue from sales of regulatory credits. In other words, fantastic result, but most of the good news have already been priced in before, hence there isn't much upside surprise. So aside from looking at the fundamentals, you also need to understand what have been priced in the share price. So at today's valuation, is this still a good buy? If we look from a long-term perspective, if the company is able to continue to ramp up their production by 40% per year in the next 10 years and successfully roll out the full self-driving, I would say that the company would worth more than 550 billion market cap. It could easily exceed 1 trillion. However, if they are unable to meet the sales growth, be it from production problem or due to lack of demand, or if they face difficulty in rolling out the full self-driving in coming years, then I would not be surprised to see the share price to stagnate or even drop from current level. Why am I telling all this? The reason is that I want to encourage you all to focus on the development of the company, track their progress against what they have promised, and focus less on the short-term price fluctuation. Share price drop should not be a problem for you unless you are looking to sell in the near term. If you need the money in the near term, then you should not invest in stocks at the first place. If you are investing for the long term, why let your mood affected by such fluctuation, right? Just sit back and relax. Watch the stock market reaction to the news, but your heart needs to stay calm. It is by maintaining the cool that you won't make mistakes. If the share price of the companies that you like fall to an attractive level, pull up your war chest and just buy. If you are like me, run out of war chest to buy, then just do nothing. Focus on the long term, track the fundamentals instead of the share price. That's all for today. Let me know how do you weather the market storm and what do you do to make yourself chill down. As always, stay safe. Cheers.